All right, let's get right into it. When the name Michael Burry pops up, people who follow the markets, they tend to sit up and pay attention. We're talking about a legendary investor, the guy who famously made one of the boldest calls in financial history. And, well, he's at it again, making another huge move that's got everyone talking.
Yep, you heard that right. The man from The Big Short is now betting over $1 billion that this massive AI stock boom is about to run into a brick wall. And a move that big, well, it forces us all to ask a pretty serious question.
Is Burry seeing something that everybody else is missing? Or is there something else going on here entirely? That's exactly what we're going to unpack. First, let's just look at what's actually happening to these stocks.
So this isn't just some theory. The fear is real, and you can already see the ripple effects hitting some of the biggest players in the AI game. The numbers really speak for themselves.
I mean, look at this. The immediate fallout is pretty clear. You've got key chip makers like Nvidia and AMD dropping 10%. And then companies like CoreWeave, which are deep in the high-performance computing space, they've been hammered even worse, down over 20%. So what's the main thing causing this sudden drop?
Really, a lot of this boils down to the incredible influence of just one person. Michael Burry's moves don't just predict the market, sometimes they can actually move the market. And what he's just done is a perfect example of that power in action.
Just take a second to absorb the scale of this bet. His fund has put a massive $900 million short position on Palantir and another $200 million against Nvidia. Put that together and these bets make up an insane 80% of his friend's entire portfolio. I mean, it is a definition of an all-in move. But what does a short actually mean here? Okay, this is probably the most important point to understand. A short position isn't necessarily a bet that AI as a technology is going to fail. Burry isn't saying AI is worthless. What he's betting on is that these stocks are overbought. Basically, their prices just shot up way too fast, and they're due for a temporary drop, a correction, before they probably climb again.
And this is where things get really interesting. Because of who he is, Burry's bets can literally create a self-fulfilling prophecy. Think about it. He places the bet. The media, of course, goes crazy reporting on it. That fear then spreads like wildfire to other investors. And what do? They start selling, which causes the price to drop, the very thing he was betting on in the first place.
This quote just nails it. His influence is like a giant loudspeaker. He might not be pointing out a real crack in the foundation, but his announcement is so loud and comes from such a credible source that it causes a stampede for the exits anyway. This is what we call market noise. It's movement based on headlines and panic, not on the actual fundamental health of the company.
But here's the thing. Burry's big bet isn't happening in a vacuum. It's landing in a market that was already nervous for a much, much bigger reason. It's basically creating a perfect storm of fear.
So you've really got two different things feeding the anxiety right now. On one side, you have Michael Burry's short, which is laser focused on the AI sector. But on the other side, you've got this general widespread pessimism about the economy that's dragging everything down. And you can see that pessimism right here. This is the University of Michigan's Consumer Sentiment Survey. Think of 100 as neutral. Just before the pandemic, we were at a pretty positive 115. But today, it has absolutely plummeted to 52. To put that in perspective, that is the second lowest reading in history. It's even worse than it was during the big market crash in 2022. It tells you people are feeling really down about the economy. And here's why that number is so critical. When people feel bad about the economy, they pull back on their spending. And less spending means less revenue for companies, which means lower profits. This is a real fundamental problem that puts a damper on the entire stock market, and it makes everyone extra jumpy when a scary headline about Michael Burry comes along.
Okay, so we've got market noise from Burry, and we've got real economic fear from consumers. It's a messy, chaotic situation. So the big question for any investor is, how do you tune out all that distracting noise and find the actual signal?
And this, right here, is the absolute core of the whole thing. The noise? That's the headlines, the panic selling, the gut reactions. It's all emotion. The signal, on the other hand, that's found in the data. It's about looking at objective numbers that tell you what's really going on under the surface.
One of the best tools for this is CNN's Fear and Greed Index. It basically takes 7 different market indicators and boils them down into one simple reading. And right now, as you can see, it is deep in extreme fear territory. And you better believe the news about Burry's bet helped shove it down there.
So, how do we know when all this extreme fear might actually be a good thing, when it might signal an opportunity? We can zoom in on a couple of key parts of that index. Two of the big ones are market momentum and the VIX, which measures volatility. History shows that a fantastic buying opportunity often appears when market momentum falls below its 6-month average and the VIX spikes above 30. And as you can see, we are not quite there yet.
And that brings us to the real payoff here. Because understanding all this fear and all this data, it's not just some thought exercise. It's about spotting a powerful contrarian opportunity that most people are too busy panicking to see. You've probably heard this quote before, but it's a classic for a reason. These moments of intense fear, especially when they're driven by noise, instead of a company actually failing, are exactly when fortunes can be made. The whole point is to be ready to act when everyone else is running for the hills. So where might an opportunity like that be hiding? Well, let's take a look at a company like CoreWeave. They're a major player in AI cloud computing, and they have an incredibly tight relationship with Nvidia. They get first dibs on Nvidia's newest tech, and they're actually Nvidia's single biggest public investment. They are right at the center of the AI revolution. So even though its stock is down 20% thanks to all this fear, some data-driven models that project a company's future earnings, well, they suggest its real value could be 300% higher than its current price. That is a gigantic mismatch between the fear-based price and the data-based value.
And it's not just CoreWeave. The same fear is creating what could be opportunities in other tech titans. The same kinds of models suggest Amazon has a 20% upside, and Meta Platforms, which is pouring billions into AI, could have an 81% upside from where it is today.
So here's the bottom line. The strategy here isn't just about buying the dip whenever something falls. It's about using objective data to find these huge gaps that open up between a stock's price, which is getting pushed around by fear and noise, and the company's real, fundamental, long-term worth.
In the end, the Michael Burry effect is just a powerful, real-time lesson in how headlines and fear can completely disconnect a stock's price from its reality. And that really leaves us with one final question to think about. When the market gets this noisy, how will you find the signal?